Good afternoon, everyone. Thanks for joining us today. This webinar is all about helping traders navigate tax season with useful tips to make the process smoother. We're excited to have two expert guests with us, Robert Green and Darren Neuschwander. Before we hand things over, let's go over a few quick disclosures. Everything discussed today is for informational purposes only and not a recommendation. Active trading, especially options, carries a high degree of risk and isn't suitable for everyone. Past performance doesn't guarantee future results. Also, Robert Green and Darren Neuschwander are not affiliated with TradeStation, and their views are their own. TradeStation does not provide legal, tax, or investment advice. Please consult a tax professional for guidance. Now, let's introduce our speakers. Robert Green is the founder of GreenTraderTax.com and a top expert in trader taxes. He's written tax guides, led industry webinars, and previously co-owned a CPA firm focused on traders. Darren Neuschwander co-founded GNM and oversees its tax compliance and accounting operations. He's been with Green Trader Tax since 2002, ensuring top-notch standards and best practices. Let's give them a warm welcome. Robert and Darren, take it away.
Okay, today we're going to talk about tips for options traders on preparing 2024 tax returns. You're probably working on your taxes right now, and options can be pretty complicated, and trader tax status is another unique area. Put the two together and you have a lot of tips that we're going to give you today to help you get a good result. So here's a current photo of me, Green Trader Tax. Here's Darren Neuschwander from Green Neuschwander and Manning. That's the CPA firm, G&M Trader Tax, that handles traders. And options traders are a big component of that now. Darren, how you doing today?
Doing good, Bob. Thank you for having me as part of this webinar with you.
So Darren, out of the list of clients, and I know it can go to thousands when you consider consultations, what percent are options traders these days? It seems like they're all the rage.
It's a very large percentage of our trading clients, just because of the availability within the option market. We're seeing less and less people trading straight securities, less trading straight futures, and more trading options on a daily basis. So it's a large percentage of the overall client base for sure.
Now, why is that? People get more bang for their buck out of less capital tied up, or there's more volatility? And what kind of strategies are they using? Are they doing outrights, complex trades? What are they doing?
The answer is yes, really, to all of that. It's not one unique factor why people are trading them. So it fits into most traders' overall strategies, as opposed to just trading the straight out equities themselves.
What kind of misconceptions do you see options trader have when it comes to their taxes?
The biggest one is wash sales. Most traders don't feel that wash sales apply to the trading of options, but unfortunately, that's not the case. So we have to strongly consider the wash sale calculations, and also advising them about considering electing mark-to-market accounting for the benefits of not being subject to wash sales, which I know that you'll go into today.
Well, you can't blame them for being a little confused, because the broker 1099B has a different method for calculating wash sales. They do it on the identical symbol, CUSIP number. The IRS wants the taxpayer to do it on substantially identical, which means the equity and the option at the different exercise dates. So someone may get a 1099 showing no wash sales. They think they're home free, but they may have a big problem. How many of the clients fall into that trap?
More than what you would actually think. A lot of times we recommend a third-party software called TradeLog, which you can download your data from your brokerage firm into it and run the gain and loss report as you as the end taxpayer are required to do to properly calculate wash sales.
And the wash sales are across all accounts, so you have to do it on your TradeStation account and your other brokerage account.
And maybe your retirement account also, your IRA.
Right. So we're going to get into all that. We're going to talk about the tax treatment for equity options as opposed to, let me hold on a second. Let me give you a quick disclaimer. This information is educational. Where necessary, you should get a qualified tax advisor like Darren Neuschwander and the team at Green Neuschwander and Manning G&M Trader Tax. It's educational information. So we're going to talk about taxation of equity options securities. This is the big difference. Equity options securities versus futures options, which are 1256 contracts. That's with the mark-to-market accounting, the 60/40 capital gains rate, no wash sales. So the big difference is always 1256 versus securities. And when it comes to options, it's all across the board. So we're also going to talk about, after we cover options, we're going to talk about trader tax status. That's when you're in the business of trading. A lot of TradeStation clients, Darren, are they qualifying for trader tax status? Are they active traders?
Some are, some aren't. So that's what we take them on an individual basis, review their overall trading activity for the year to see whether they actually do qualify.
Because if they do qualify, they get the business expenses. They can make a 475 election to get out of the wash sale loss problem and the capital loss limitation and the QBI benefit on gains. And they can do other things as well, like the retirement and health in an S Corp, a SALT cap workaround in a partnership. So trader tax status is the unlocks the door to a lot of benefits. And you can be a securities trader, a futures trader, cryptocurrency trader, a Forex trader, whatever you trade, you can qualify for trader tax status. I'm going to talk about how to qualify. So here are the big differences up front in an overview. Equity options are securities. As soon as you hear securities, you think the realization method. You pay taxes when you make a sale. That's when you complete the transaction. It's not mark to market unless you elect mark to market as a trader tax status trader. And then we'll go over the reasons why you may want to do that. Day traders are not so worried about mark to market. They're cleaning house at the end of a day or a week anyway. So trading securities triggers the wash sale problem. We touched on that already, which can defer capital losses to the subsequent year, raising your tax bill. So the 1099B does not calculate wash sales between equities and equity options, but you're supposed to do that. We already discussed that. Your 1256 contracts are 60-40, 60% long-term, 40% short-term. It's a lot easier to do the accounting because it's mark-to-market and summary reporting on the 1099B. And if you have a loss, you can do a loss carryback. So futures options really give you a lot of benefits. Darren, my understanding is most of the options traders, like you said, are trading equity options, not so much the 1256 contract options, the futures options.
It's a fair mix. A lot of taxpayers are seeing the overall tax benefits of trading Section 1256 contracts over securities. It just, by definition, you get the 60-40 split. There's less from a compliance standpoint, not having to report all of your line-by-line option trades on your tax return if you're trading future options. The ability to possibly carry back a Section 1256 loss to the previous 3 years that you had Section 1256 gain that you paid tax on. So there's a lot of, from a taxation standpoint, there's a lot of benefits of trading future options versus equity options.
Okay, let's continue this from this overview slide. Trader tax status in Section 475. So traders eligible for trader tax status, that's making 4 trades a day, 4 days a week, and more. If you look back and you see you have that, it unlocks business expense deductions, but it also allows you to elect 475 mark-to-market accounting. If you're trading complex options with straddles and all offsetting positions, it can get very confusing for an equities options trader. If you're trading a lot and elect 475 with mark-to-market, all of those offsetting position rules go away. And we're going to cover those shortly. It can get very complicated. So we love 475 because no wash sales, no problems with the complex options trades and all the losses allowed and the deduction on income, the QBI deduction. So 475 exempts the securities trades from wash sale losses and the annual 3,000 capital loss limitation. Makes you eligible for the 20% qualified business income deduction. But you can't just pull that out of the hat now for 2024. You had to elect that by April 15th, 2024. The next election is for 2025. Individuals must submit it by April 15th, 2025, which is coming up. And S corporations and LLC partnerships must submit it by March 17th. That's right around the corner. So if you missed the boat on 475 for last year, definitely consider it for this year. And there's a lot of nuances to it. Darren, how many of the options traders are using 475? And is it helping the ones that trade the complex options?
If they don't have any capital loss carryovers, we strongly recommend electing Code Section 475F mark-to-market accounting just because of the benefits of it. Not, as you mentioned, not having to worry about the complex straddle rules, constructive sales rules at the end of the year. It basically kind of falls in the same pattern of the benefits of someone trading options on futures. So you don't have to worry about that aspect. So we do strongly recommend it if you don't have any capital loss carryover.
Okay, so let's talk about the options tax treatment. We usually like to say options have diverse tax treatment. Options are derivatives of their underlying instrument and generally have the same treatment. So if you're trading an equity option, it's taxed like an equity, which is a security, which is that body of law with the wash sales that we talked about. Now, equity options, for example, are derivatives of underlying equity in our securities. So we already covered that. So futures options are derivatives of regulated futures contracts. They are Section 1256 contracts with mark-to-market accounting, different from 475. This is Section 1256. The MTM is built in. So because of mark-to-market, there's no deferral at year end. There's no wash sales. There's no complex offsetting positions from complex trades. It's all mark to market. You're squaring the books at year end. And you're also getting the lower 60/40 tax rates. So tax treatment for equity options includes simple outright and complex option trades with multiple legs. So options tax as securities, equity stock options. So if you trade Apple the security, if you want to trade Apple the option, that's also taxed like a security and wash sales apply. So it also applies to options on narrow based indexes. So if you're trading futures indexes, most of them are not narrow. There's just maybe one or two that are. Narrow means made up of 9 or fewer positions. Most stock indexes are broad based like SPX, NASDAQ, Russell. Any of the major indexes are made up of a lot more than 10 underlying securities. So they're futures options. They're options on futures and they're taxed just like 12. So the options on the narrow-based indexes are securities. Options on the broad-based indexes are futures. Options on securities ETFs structured as registered investment company RIC. So when you look at the underlying, it's using the registered RIC structure. The RIC structure is synonymous with an equity. Hence, it's taxed like an equity option. But there's some confusion on that with a few of the brokers. Darren, why don't you tell us about what's happening with one of the brokers in treating options on SPY. SPY is an ETF. Option on the SPY, which is a RIC, we're saying is like an equity option, is a security. But one broker is standing out now. They're trying to treat it as an option on a non-equity, saying that the ETF RIC is a non-equity, and we don't agree with that. But do you have any other developments with that, Darren?
No, I mean, you pretty much summarized it. It's a different position than what we've seen any other brokerage firms take on the options on SPY, in that this particular brokerage firm is saying that they are Section 1256 positions, and we strongly disagree with that. But that's the stance the brokerage firm's taking. That could adversely affect you as the taxpayer if you had a loss in it for the year and you have mark to market in place and not being able to use mark to market accounting. In that particular case, we're having to take it on a taxpayer by taxpayer basis. That's using this particular brokerage firm and explain to them what's involved. And there's no need of going back to the brokerage firm themselves because that's their position. That's what they're going to take. But you as the taxpayer, maybe based on professional opinion and our research, can take a different position.
Okay, so options taxes 1256 contracts. Non-equity options are a catch-all. So if the underlying is not an equity, it's not a RIC, it's not a corp, regular corp, it's something else. For example, it could be a publicly traded partnership. If it's a commodity ETF, it could be a publicly traded trust, a precious metals ETF. It could be a ETN prepaid forward contract, the volatility. So you have a CBO listed option on something. Is it on an equity or a ETF RIC? In that case, it's a security. Or is it on something else? And if it's not an equity, it's a catch-all. Commodity ETF is a publicly traded partnership. It's widely traded. The option on that is a non-equity. It's 1256. Precious metals ETF like the GLD is on a publicly traded trust. That's not a secure underlying security. So the option on it is a 1256. The ETN, the VIX, the VXX is a prepaid forward contract. It's not a security. So if you're trading that and you wanted to use mark to market with 475, you couldn't. You can't get the ordinary loss, and you don't have to worry about wash sales on the VXX because it's not a security. Cryptocurrency is not a security. These CBO listed options on all these instruments that are not securities, publicly traded trust, publicly traded partnership, prepaid forward contract, they're all 1256 contracts. And also the Forex OTC options are. So generally, when it's going to be a 1256, what you're looking for is a qualified board of exchange labeled, which are a 1256 contract, unless the reference meaning what it's traded on, is a single stock, an equity, or a narrow-based stock index. Your non-equity option is any listed option that is not an equity option. Non-equity options include debt options, commodity futures options, currency options, broad-based stock index options. A broad-based stock index is based on a value of a group of diversified stock or securities. Remember, in the biggest case probably out there, you're talking about SPY, that's this ETF, RIC. So the options on the SPY are a security. Now, conversely, the SPX is a stock index future, and the option on the stock index future should also be 1256. That's where the disconnect with this other brokerage firm is, because they're departing from that basic treatment. Now, let's talk about the wash sale rules, how they apply to securities options. We talked about it a little bit up front on the call. For options taxes, securities, wash sales apply between substantially identical positions in securities, which means between equity options, such as Apple stock options at different expiration dates. So let's say you're trading with these wash sales all year long. The key thing is to break the chain at year end, because it's unavoidable if you're an active trader to have wash sales. Unless you have trader tax status and elect 475, you're going to be stuck with these wash sales. So come December, let's say you get out of all your position A, or let's say it's Apple, on 12/15. Get out of your securities and your options, and you don't buy back in for 30 days until January 16. In that case, you broke the chain and there's no open wash sale at year end, because if there is, you're going to have to defer the loss to the next year. And this is going to apply against all accounts, including taxable versus IRA accounts. So these are the IRS wash sale rules for taxpayers, which are broader than the rules for brokers. You can't expect TradeStation to open their books to cooperate with another brokerage firm to calculate wash sales across those two mediums. And it would be very difficult for them to calculate wash sales between stock and options. The IRS just wanted them to have the basics. You can't blame all those parties. But on the other hand, the IRS knows that you can definitely game the system. We used to have clients come to us, they'd have a whopping big wash sale on December 28th. They wanted to catch the year-end rally or the beginning of the year rally. So they jumped back in their IRA account thinking, I'm going to game the IRS. I sold them my taxable. I'll buy it back in my IRA. That doesn't work. If you get busted on that, you're going to have to pick up that. That's a permanent wash sale loss that you can't even fix, because there's no way to fix it with your IRA account. Now, if you work with an account that says he can just use your 1099B, import your 1099B, or do your trades manually or use an Excel worksheet, they can't. It's just way too complicated. You need third-party software that works well, and that's TradeLog. We're going to talk about it more later, where you download your trades right from TradeStation. How does TradeStation work with TradeLog, Darren?
Very well, from what I've been told.
Okay. I use the concept of simple versus complex options trades. Simple option trading strategies such as buying and selling call and put options are known as outrights. Tax treatment for outright options trades is relatively straightforward. We're going to talk about that shortly. Now, complex options trades, which a lot of traders do, they're very smart, these options traders. They're known as option spreads. They include multi-legged offsetting positions such as iron condors, butterfly spreads, vertical, horizontal, diagonal spreads, and debit and credit spreads. These are more complicated for tax reporting. Complex options trades trigger a bevy of IRS rules geared towards preventing taxpayers from tax avoidance schemes, deducting losses and expenses from the losing side of the trade in the current tax year, while deferring income on the offsetting winning position until a subsequent tax year. That's why the IRS likes mark-to-market accounting. That's why they originally created marked accounting for futures traders who were doing these kind of complex options trades before 1986 when they came out with mark-to-market for futures. They were gaming the system. They'd put on all sorts of positions with very little economic risk, close out the losing positions going into year end, leave the other ones open. Now, TradeLog may not even fully handle the complex options trade, so you got to have to work on that a little bit yourself. Is that still the case, Darren?
Yes.
Okay. So traders eligible for TTS often elect 475 mark-to-market to avoid distorted losses. Straddle rules can be very complicated and beyond the scope of today's presentation. How often do you run into a lot of complex trades where it's very difficult to figure it all out, Darren?
I mean, we do. To put an actual number on it, I can't say for certain, Bob.
But it is a problem.
It can be. Yes, it can.
All right, so let's talk about the outright options trades. There's three things that can happen with the outright trades. You can trade the option, have a closing transaction, sort of like with an equity. You buy an equity, you sell it. So trading calls and put equity options held as capital assets are taxed the same as underlying equities. Taxpayers should report proceeds, cost basis, wash sale loss adjustments, and net capital gain or loss and holding period, whether it's short-term or long-term, held 12 months or longer for the lower rate, and it's on realized transactions only. Now, Darren, with our options traders, there are some strategies that let them expire, but do most traders do outrights with number one where they have a closing transaction?
They do, or either they let the option go to expiration, which when you're counting trader tax status, expiration doesn't count as one of the trades.
But if it's a weekly, it's not too bad for holding period.
Correct.
So Section 1256 futures options are summarized with MTM on 6781. But this is the trade option for equities, the closing transaction. That's the first thing that can happen. The second thing that can happen is the option expires, it lapses. The above scenario can have a minor twist. Rather than realizing a dollar amount on the closing out of the options trade, so you got those two columns on the 8949, the proceeds and the cost basis, the purchase price. So rather than realizing a dollar amount on the closing out of an options trade, the closeout price is zero. Since the option expires worthless. That's not too big a deal. You just put in zero rather than some other number. So use zero for the realized proceeds or cost basis, depending whether you're the writer or the holder of the option, and if it's a call or a put. So if I try to explain it to you, it can get very complicated, but just use your common sense. Collecting premium on the options trade counts as proceeds because you're getting money in, it's proceeds. Therefore, the corresponding worthless exercise represents zero cost basis in this realized transaction. So for guidance on entering option transactions as expired on Form 8949, read the publication 550, which is a great publication, Capital Gains and Losses and Options. Darren, are the 1099Bs reporting these lapsed trades properly?
We haven't seen enough of them this year to say for certain.
Let's say last year. Because I know at one point someone was putting, instead of proceeds getting adjusted, they were adjusting cost basis. I have a little bit more on that later, but you're saying the 1099Bs for last year were pretty good on this?
Yes, they were. Yes.
Okay. Now we're getting into a little bit more confusion. And this is not necessarily something that traders do because they're in and out, but where you exercise the option, this is where the tax treatment becomes more complicated. Exercising an option is not a realized gain or loss transaction. That's the first D part. It's a stepping stone to a subsequent realized gain or loss transaction on the underlying financial instrument acquired. The original option transaction amount is absorbed. It's adjusted into the following financial instrument cost basis or net proceeds amount, whether you're long or short. So it's sort of like you paid a little money as a down payment to acquire stock, which you did a little later on. Now, don't try to game the system and say, I paid my deposit over a year or, months ago, and now I want to use that for my holding period to get a long-term capital gain. You can't do that. So publication 550 states, if you exercise a call and it's cost to the basis of the stock you bought. That's not very good writing. I didn't write that. That's why I had trouble reading it. That's right from publication 550. So you're adding it to your cost basis. If you exercise a put, reduce your amount realized on the sale of the underlying stock by the price of the put when figuring your gain or loss. Any gain or loss on the sale of the underlying stock is long-term or short-term, depending on your holding period for the underlying stock. You might have paid your deposit on the option up front months before you got the stock or a month before, but the holding period starts that month later when you acquired the stock. If a put you write is exercised and you buy the underlying stock, decrease your basis in the stock by the amount you received for the put. If a call you write is exercised and you sell the underlying stock, increase your amount realized on the sale of the stock by the amount you received for the call when figuring your gain or loss. So it can get a little confusing because there's whether you're long or short, whether you call or put, writing holder, but just think it out. This makes sense if you read it over slowly. It's from the publication. Now, some brokers interpret these IRS rules differently, which can lead to confusion when attempting to reconcile the broker issue 1099-B to trade accounting software. A few brokers may reduce proceeds when they should have added the amount to the cost basis. Exercising an option gets to the basics of what an option is all about. It's the right to, not the obligation, to purchase or sell a financial instrument at a fixed strike price by an expiration date. Exercise may happen at any time until the option lapses. An option can have an in-the-money option before the expiration date and choose not to execute it, but hold or sell it before expiration. So go back and look over this 550 verbiage and make sure it makes sense to you. Now, the holding period for long-term capital gains, when a trader exercises an equity option, the option holding period becomes irrelevant. The holding period for the equity begins anew. This is what I've been talking about. The holding period of the option doesn't help achieve a long-term gain. When an option is closed or lapsed, the option holding period dictates the short or long-term treatment with those exceptions. So you got to read those exceptions. Buying a put option is generally treated as a short sale, and the exercise, sale, and expiration of the put is closing of a short sale. If you have held the underlying stock for 1 year or less, when you buy the put, any gain on the put's exercise, sale, or expiration is a short sale. You might think it's long-term, but it's not. It's a short sale. It's a short-term capital gain, not short-term capital gain. The same is true if you buy the underlying stock after you buy the put, but before its exercise, sale, or expiration. I don't want to go into examples because it can get a little confusing, but that's the long and short of it. For more information about it, straddles, and a lot more, read our blog post about it from 2015. Just click through on the link on this. I'm going to put these slides up on our website page for this event, and you can download the slides and click on the links. So did you want to say anything else, Darren, about those complicated rules for the options?
Just as you mentioned, they are complicated. And if you're new to options and the taxation of it, I would encourage you to go take a look at these slides on your own time and take a little more time to digest everything, because it's a lot of information, more than we could really go over in this presentation. So encourage you to take a look at the slides. And then if you have detailed questions on it, you're more than welcome to sign up for a consult with us and we can discuss your individual questions.
I see on TV they have some really complex options trades they recommend on CNBC and other forums. People need to understand the tax treatment as well. You don't want to find out after the fact when you're sitting with your accountant calculating your taxes and find out you made all sorts of mistakes. You want to get on top of this early on. So I would suggest a consultation with Darren and the team to go through it after you go through the slides more. Darren's right, I rushed through. It's good to get some examples as well. And you can do that with the TradeLock software to see how it's handled. So we recommend 475 on the complex options traders to avoid the complications of the offsetting positions and to avoid the wash sales on the outrights. That concludes part one about options. We're about a half hour into this, a little bit more. Now let's talk about trader tax status in section 475. As he said up front, as he promised, we were going to expand this beyond just options trading. Ever since they came out with the weeklies rather than the monthlies, a lot of options traders trade the weeklies, and that can qualify for the trader tax status where your holding period has to be less than 31 days. So trader tax status constitutes business expense treatment and unlocks meaningful tax benefits for those who qualify. The first step is to determine eligibility. No election is required for trader tax status. Darren will give you a good analogy coming up on that. So with trader tax status, TTS, consider submitting a Section 475 mark-to-market accounting election on securities and/or commodities, probably on securities only, by April 15th. So if you had a problem with wash sales and complex options trades last year, and you don't have a lot of capital loss carryover going into this year, you may want to consider the 475 election by April 15, 2025 for 2025. Also, you might want to consider an S-Corp with TTS to deduct health insurance and a retirement plan, which a sole proprietor trader can't deduct. SALT's a little above the scope of today's call. So before we get too much into trader tax status, let's talk about qualification. Darren, do you want to give this slide and give a little commentary as well?
I can. So basically, trader tax status is something that you qualify for. As Bob mentioned, there's not a formal election for it. If you either qualify for it or you don't. And if you qualify for it, then you're eligible as an individual taxpayer to file a Schedule C and deduct your trading related expenses. So you're preparing your 2024 tax returns right now. They're due April 15th as an individual. If you meet the definition of a trader, you still potentially could qualify and deduct your trading related expenses for tax year 2024. So go back a slide, Bob, and let's go over the qualifications. So what you're seeing here are the primary qualifications for trader tax status. So the IRS doesn't actually quantify what trader tax status is. They have a narrative that basically says your trading has to be substantial, frequent, and continuous. So we look to tax court cases that have actually gone in and put numbers to that narrative. And from gathering all the recent tax court cases, we haven't had any tax court cases related to trading post-COVID. So all of these are pre-COVID, but we have combined all of them and looked to see what the tax court said that this person either did or didn't qualify for trader tax status. And this is what we call our golden rules. So on an annual basis, you've got to have at least 720 trades. Frequency, you've got to be trading 75% of the days the market's open. So the market's open roughly 252 trading days out of a year. 75% of that is around 185 days. So I've got to see trades on roughly that many days of the year. And your holding period has to be, your average holding period of all your trading positions has to be basically under a month. So we got to meet all three of those. It's not a cherry pick where you meet one out of the three. No, it's three out of the three. You fail one, you fail. So where we see most people that are trading options fail qualification for trader tax status is on the frequency. They're not trading 75% of the days the market's open. They may easily meet the 720 trades and their holding period is under a month, but they're not trading on a daily basis. So really we boiled it down to, if you want to qualify for trader tax status, you've got to have basically 4 to 5 trades a day, 4 to 5 days a week. And if you do that, that opens up the door for trader tax status. Trader tax status and mark-to-market accounting, which we'll go over the benefits of that, most people get those confused. They're two separate things, but they're very much related. And the best analogy I can give people during our consults to try to break it down and make it as elementary as possible to help understand the difference is the following. You're going to college and your ultimate goal is to get a master's degree. Now, you can't go to college on day one to get a master's degree. You have to have your bachelor's degree first before you can even get into the master's program. But no one says you have to get into the master's program. Maybe for what you want to do, the bachelor's degree is sufficient enough. Well, trader tax status is the bachelor's degree. Mark-to-market accounting is the master's degree. You can be a trader and not elect mark-to-market. You can have your bachelor's degree and not get your master's, but you can't use mark-to-market accounting if you don't qualify for trader tax status. You can't have that master's if you don't have the bachelor's. So for 2024, the best you can do if you didn't timely elect mark-to-market accounting on or before April 15th of 2024 as an individual is that bachelor's degree. You could still potentially qualify for trader tax status, deduct your out-of-pocket trading related expenses. So then you need to consider, do I want to get into the master's program for 2025? And that's got to be done on or before April 15th of 2025. It's the only election in the Internal Revenue Code that you got to do before the fact, not after the end of the year. So the IRS basically gives you 3.5 months of a year to make that determination. They don't want you waiting to the end of the year to decide whether you are or are not going to elect mark-to-market, because it may be prejudice in their eyes. So they at least give you 3.5 months as an individual, 2.5 months if you're filing a partnership or an S corp return.
So Darren,
Yes, go ahead.
what are the major business expenses for the trader with the TTS? Which if they come to you this week, they can get for last year. They didn't have to elect anything. The business expenses are on the table.
Well, there's all aspects of that. Every trader is different. I mean, if you really sit back and evaluate what you're doing, you probably have multiple monitors, multiple computers, you've got internet, you've got communication costs, you got chat rooms, you got maybe some training that you've taken after you started trading, maybe some before. You've got a home office deduction. Every trader is different. We've got some traders that have $5,000 or more of expenses every year. We've got some traders that have $500K or more. It's just depending on what all you're doing and what all expenses you're paying. You may be paying some brokerage fees. If you're short selling, you may be paying some hard to borrow fees. So to give you an exact amount of how much you're going to have for trading, I can't. We need to kind of go over your facts and circumstances and see what you have and what you're paying out of pocket. And if you reach the level for trader tax status, those expenses potentially can become deductible expenses, whereas as an investor, which is someone that doesn't meet the level of a trader under current tax law, investment related expenses are not deductible. So there is a tax advantage if you meet the definition of a trader to file as a trader to deduct your out-of-pocket trading related expenses.
And the savings can pay your accounting fee many times over, which can also be a business deduction.
Correct.
Schedule C. So we talked about 475. So let's talk about the tax reporting for a sole proprietor. Someone comes to you, you tell them they do have the trader tax status. So how do they go about filing? What are you going to do with them, with the forms and everything else?
The trading related expenses go on Schedule C as in cat. That's the only thing that goes on Schedule C is your trading related expenses. If you're trading options on securities, options on equities, and you have not elected mark-to-market, that's going to go on Form 8949 and eventually flow into Schedule D. If you're trading futures, that's going to go on Form 6781 and then flow into Schedule D as capital gain and loss. If you've elected mark-to-market, it's going to be on Form 4797. So that is what's so unique about filing a tax return for a trader. It's not like any other type of business. You've got separate forms. You got income reported on one form. You got expenses on another form. And all of this is coming from IRS publication. There's a chapter in that publication that says this is how a trader prepares his or her tax return. And most CPAs that don't work with traders on a daily basis, they end up putting everything, all of your gains and losses directly on a Schedule C, which is entirely incorrect and is more likely going to generate an IRS notice because the IRS is expecting to see all your trading activity on one of these other respective forms like an 8949 or 6781. So if you're working with a CPA that doesn't understand trader tax status and you definitely qualify and want the benefits of it, you really need to evaluate, do I want to continue this relationship with this CPA or should I work with someone that works with traders on a daily basis?
Yeah, because it's counterintuitive to those other accountants. They think everything for a sole proprietor goes on Schedule C. So Darren, here are some tips. Maybe you can walk us through this as well. The footnote, the transfer strategy, tying it all together. So when the IRS opens a tax return, they say, here's a trader in securities. I understand what that means. I see how this client qualifies. I see a 1099-B with 100 pages of transactions or more, and I can understand whether they're profitable or losing. It's not just a whopping loss on a Schedule C and the story. There's a lot more to the story. And you got to prepare the return, which says this is a business trading account, this was an investment account. So tie together the business showing the net profit that the client is profitable. So don't disenfranchise yourself. So go ahead, Darren.
For every tax return that we prepare, whether it's an individual trader or whether it's an entity, we put in a 3-page footnote to the IRS, basically attaching it as part of the tax return that, as Bob mentioned, it explains to anyone picking up that tax return, whether you're filing a federal return or a state return, why you as a taxpayer qualify for trader tax status and where the respective income and expenses are reported. And if you're profitable for the year, we may do a transfer strategy where we'll transfer some of your profit from maybe 8949 over to Schedule C. So we zero out the expenses on Schedule C. If you're not profitable for the year, of course, there's not any profit to transfer. So in that case, we can't do that. But trader tax status, you don't have to have an entity for that. You can qualify for that as an individual, as a sole practitioner. So if you're filing a married filing joint tax return and you qualify for trader tax status, you can file that Schedule C and deduct your trading related expenses, even for tax year 2024. In fact, if you qualified for any of the previous 2 years, we potentially could file amended tax returns for those years if it makes sense. That is, if you had a large amount of trading related expenses to get you a refund of potentially some taxes. So there's an opportunity there for some open tax years to file amended tax returns.
Darren, maybe you want to explain a little bit about the capital loss carryover and the misconceptions about that.
Yeah.
And any other tips for the 8949, which can be a confusing form, but a lot of the brokers help provide that now, don't they? Even though that's not really reliable, we want it from the trade lock software, which generates that form with the correct washer loss reporting.
So I'm seeing a lot of questions in this presentation about the confusion over the $3,000 capital loss limitation. And I wish this was better explained to where people could easily find this question on the internet. But
it's on our website.
It is. If you have an overall capital loss for the year, and let's just say it's $100,000, the max, and that's your overall net capital loss for the year, taking all your gains and losses, your capital gains and losses from all sources, you put them on Schedule D, and you have an overall loss of $100,000. The max that you can deduct of that $100,000 against any other sources of income you have on page 1 of your individual tax return is $3,000. That's called the capital loss limitation rule. That doesn't mean that you're only going to be potentially allowed to take $3,000 of that $100,000 loss carryover for the rest of your life. The only way that would happen is you basically didn't generate any capital gains ever again. In that case, yes, you would take $3,000 every year. Let's say in 2024, you had the 100K capital loss, you took 3,000 of it. So now we got $97,000 of capital loss rolling into 2025, but you turned things around. You started actively trading in 2025 and you made $100,000 in 2025. If you have a capital loss carryover of 97,000, you made 100K this year. That all goes on Schedule D. And the gains of 100K gets netted against your capital loss carry forward dollar for dollar. So that's 97,000. So what do you have net? You have a net gain of $3,000, and that's all you pay tax on. And you have no more capital loss carryover. It is used up. That is the biggest misconception. People think that they're stuck with 3K of capital loss forever.
And if that was the case year to date where they made the 97,000 using up the capital loss carryover, they may not want to elect mark to market because that rolls back to January 1st as ordinary income that does not absorb capital loss carryovers. That's one of the nuances where you really need to speak to a professional who knows Section 475 inside out. And if you sit down with Darren and team over the coming weeks and know what you're doing year to date and know what you do last year, you can get back on track to making the right decisions rather than the wrong ones.
I had a consult 30 minutes before I went into this presentation, individual lost 500K from trading in 2024. And he was very headstrong on electing mark-to-market accounting for 2025. And I had to explain to him, and we broke it down as elementary as I could for him to understand. In that case, you may not want to elect mark-to-market so that your trading gains in 2025 can be offset dollar for dollar against that capital loss carryover. So there are some cases where electing mark-to-market accounting may not make sense currently,
The way
especially when you
the way
have capital loss carryover.
sorry, Darren, I didn't mean to interrupt. The way I look at it is you're going to catch the boat just at the right time. And you can have an entity for the rest of the year and elect mark to market, or you could wait to the following year. Just going into it, you don't want to continue any damage. You want to make the right call. Did you want to say something else with that, Darren?
Yeah, everybody's facts and circumstances are different on that. So the consult is where we look and try to tailor a strategy that's going to work best for you to utilize your capital loss carryover if you're in that situation. So 45-minute consult with us is very much worth that. And if you're in that scenario, you have capital losses and you want to see what's going to be the best way to offset those, having a consult with us before you file your 2024 tax return by April 15th is highly encouraged.
Now, if you're trading Section 475 with Section 475 on securities, you still have to report every trade as you do with capital gains and losses. There's no summary reporting allowed. The IRS wants to see the detail. And Form 4797 looks a little bit like Schedule D or 8949 with proceeds and cost basis. And then you have to also enter the mark-to-market trades and it's ordinary gain or loss. Do you want to say anything else on 4797?
No, I think you covered it based on our time that we have available.
Yeah. So if you do elect 475, you're going to have to file a Form 3115. I don't want to get too much into this because we're running short of time. So if you elected it for 2024, by April 15, 2024, you're working on your 2025 tax return. You're going to probably file an extension by the due date of the return, October 15th. You're going to include the change of accounting method, the Form 3115 from 2024. If you next elected 2025, April 15th, you're not going to file the form until next year when you file your 2025 tax return. It's a confusing form. There's a lot of legalese. G&M Trader Tax knows it inside out. It's a good reason to hire them to do your taxes. Any other comment about that, Darren?
No.
So entities can also elect 475. It's by March 17th. Otherwise, if you set up a new entity, let's say you set up an LLC, single member or a spousal member LLC with an S Corp election so you can deduct health and retirement, you want to get that going as soon as possible so you can get a big deduction on those items. Now, that entity could elect 475 by adopting it internally within 75 days of inception. So if you set it up on June 1st, you have 75 days from June 1st to do it. So learn the nuances of 475 on our blog post. So remember,
let's pause there because I've seen this question come up twice already today. A single member LLC by default is a disregarded entity. For it to be a true separate taxpayer that files a tax return, it's either going to be elect to be an S Corp as a one member or has to add an additional member to be taxed as a partnership. A single member LLC that doesn't elect to be an S Corp is a disregarded entity. So what Bob was mentioning about internally electing mark-to-market accounting within 75 days of forming that single member disregarded entity, that does not apply. That only applies to an entity that files its own separate tax return. A single member LLC that is disregarded has to file an election for mark-to-market accounting with your individual tax return.
Now, remember I said there's a benefit for a 475 income trader, not just for losses, the tax loss insurance, but for the income. That's that QBI deduction from the Tax Cuts and Jobs Act, which is being worked on in Congress to renew. Basically, you make 100,000, you can write off 20,000 out of the blue, no actual cash. There's all sorts of haircuts, the lower of that or taxable income. It's very confusing. It was an employment act for accountants. And if they continue it, it will continue to be an employment act for accountants. Very confusing. Darren, do people get that right on their own?
No, they do not.
So you find errors with it for people who self-file?
Yes.
All right, so traders are a specified service trader business, so they're not getting the break as much as a manufacturer. It phases out at 383,900 or 191,950 for other taxpayers, and then there's also a threshold above that of 100, married 50. So you can read more about it in the slides. Now, if you have a whopping big loss, like the client who worked with Darren earlier today, 500,000, during COVID, you could carry that back 5 years. In the old days, you could carry it back 5 years. But TCJA, to pay for all those tax cut benefits, they have tax cut costs. And that was like changing the NOL rules. No more carrybacks unless you're a farmer or a casualty or disaster insurance. So traders, no more carryback. You have to carry it forward, unlimited, and you apply it to 80% of the income. The rest of it you can use for the standard deduction at lower rates, not the end of the world. And not only that, but if that person Darren worked with lost 700,000, he wouldn't have been, and he had 475, he would have been limited to 610,000 as married, and the rest of it of the 700,000 would have been an NOL carry forward. So everybody's working on extending this. They don't want it to expire. If it does, boy, is it going to be a whole heck of a lot of confusion. All the tax changes are. So for tax treatment, go over to our website, financial products, tax treatment of financial products, including options. We talked about the 6781 futures, has the loss carryback election. You can't carry back NOL from 475, but you can carry back a futures loss, but only applied against futures gains, not everything else. Like an NOL is all encompassing. The futures is a very specific carryback, but still helpful. Answer that cryptocurrency question on your tax return or you'll get busted. It's serious business. We talked about wash sales and the adjustment already. We talked about trade log already. So a little bit about extensions before we have a few minutes left, Darren, unless you want to go with a couple of questions that you think are really good you want to raise for the room. And Jesus, do we have a hard break at 5?
We do, yes.
Okay, go ahead, Darren. Couple of questions or talk about extensions.
Just two things to reiterate. Trader tax status is not something you have to elect. That bachelor's degree is something you don't have to elect. Mark to market is what you have to elect. So there's still confusion in the chat room about that. So you can still qualify for trader tax status for tax year 2024 because there's not an election you have to make. If you meet the definition of a trader for 2024, you can file a Schedule C with your individual tax return and report your trading related expenses. Mark to market accounting, Code Section 475F, that is a formal election that has to be made to get that. That's the master's degree. Now, regarding extensions, today's March 5th. If you're just now learning about trader tax status, about mark-to-market accounting, you think you qualify for 2024, and you really want to engage our services to help you prepare that 2024 tax return, we will be more than happy to help you do that. Now, with that being said, we're going to recommend that you file an extension by the April 15th deadline. It's an automatic extension to October 15th. We still have to calculate how much tax you owe for 2024 and pay that by April 15th, but it will give you 6 more months to completely file your tax return. And if you meet the definition for trader tax status, we can file that. So there's several questions about, are we available to assist? The answer to that is simply yes. We can help you with a consult. We can help you with tax preparation. You can go to our website. You've got the email address right here, info@gnmtradertax.com. If you've got specific questions, you want to see about signing up for a consult, send us an email. Our admin team or one of our CPAs will follow up with you, and we'll be able to help you do an individual consult and then also help you potentially do preparation. You have to go through a consult with our firm before we will invite you to become a preparation client, because we want to make sure that we're going to be able to add value back to what you're doing before you engage our services. So that's the whole point of the consult.
Now, you can't stress enough the need to file the extension form to avoid the late filing penalty of 5% per month up to 5 months. No matter what's on that form, you got to get it filed. You want it to be as accurate as possible to limit the late payment penalty, which is 0.5% per month. So there's a lot of good reasons to file an extension. They're on our website. We'll have more blog posts about it. But at this point, Darren, thank you so much. So everybody, Darren and team, there's 4 CPAs at Green, Neuschwander, and Manning doing consults. There's a lot more CPAs doing tax compliance, and they've been with the firm a long time. You can read incredible bios and testimonials. You'll be very pleased. I can tell you that for sure. So thank you to TradeStation and Jesus for arranging this. We're very happy to do it.
Thank you. Thank you, Robert, and thank you, Darren, for spending this time with all of us. This is great information, a lot of information to digest as well. So yes, for additional information, you know where to go. I also want to remind everyone that TradeStation does not offer any tax advice. So make sure that you consult a tax professional for any recommendations. I want to thank everyone for spending this time with us. Thank you for attending this webinar. Robert, again, Darren, thank you for your input and your expertise. And everyone, have a great afternoon. I'll see you next time. Please check our events calendar for upcoming topics. Thank you for being here. Bye-bye.